Alright guys, so today I'm going to explain market orders versus limit orders versus stops. I want to try to explain a little bit about these because I get a lot of people that are novice with stocks kind of ask me these questions. They'll text me, usually it's my friends and stuff. So I just want to kind of go over those real quick. So yesterday the stock TLRY and a little bit today, the stock was all over the place, so there's a lot of trading going on with it. It's a pretty hot stock, and so we're going to use that stock TLRY as an example. So let's say you get on your lunch break and somebody brings it up to you that TLRY is just going crazy right now. So you open your broker on your phone. I'm going to be looking at my broker via my laptop here, so everything's going to look a little different, but no matter what your broker is, you should have markets, stops, and limits. So let's say you wanted to put in a market order, because that's just what you use. You don't really know about these other orders. You buy 100 shares on your lunch break, and your lunch break starts at 12 o'clock on the dot here. So the stock price at 12 o'clock on the dot here, we're going to look at this, and you can look up here toward the top. The high was 235 and the low was 231.96. Let's say you come over to your broker and you're like, oh, that stock's awesome. I want to buy 100 shares of TLRY. And you're going to buy them right now. Ignore this. So right now happened to be noon, and you buy 100 shares. So when you buy, you got to buy them from somebody that's selling, obviously. So you buy 100 shares. It's going to fill your order right then for whoever wants to sell them to you. On your phone, you may see the price at 232, but the price could automatically fluctuate all the way up to this upper end of this candle, which was at 235, and fill your order. That sucks. That's never fun if that happens. And that's one reason I personally don't use market orders to buy. So you put in your order to buy, somebody says, I'll sell you my 100 shares at 235. You put in the market order for 100, boom, you get 100 at 235 automatically. And that's something you can't control with a market order. So let's look at that a little different. Let's say you get to lunch, you see the stock's really moving, and you want to buy at 233, no higher. So you'd come to your broker, keep the buy, the 100 and the TLRY the same, but you change the limit, and you can change it to 233. So that means if the stock moves up to 233, it will, or let's say it was above 233, my apologies, and it starts drifting below 233. When it starts coming down, your order will start to gather shares at 233 or lower. Won't let you pick up shares higher, which is a great thing about limit orders. I always use limit orders when I purchase things. So, you bought your shares, you got 100 now. Now let's say you're still on lunch, and let's say you get an hour for your lunch. You bought over here at 233 with your limit order, and 15 minutes later on your lunch, you see it's all the way down here at 222.95, we'll say, right there. The low was 223.01 actually. So let's say you see it down here at 223, and you think, "Oh God, I want to sell. I'm losing money. I don't want to lose any more money." And you put in a market order to sell. So you sell 100 TLRY, market order. Like I said, with the market order, your order will fill at whatever anybody at this time now is willing to buy it at. Let's say somebody's got an order in at 223, but on your phone, you see the order, or you see the stock set over here on the far right. You can see the price. You can see it's at 225.77, we'll say, while you're on your lunch break. And you had bought all the way up here around 232-ish, and you see it's moved down to 225-ish. You want to sell. If you put that order as a market, somebody wants to buy it right then, but they may buy it significantly lower. They could buy it all the way down here at 223.01, and that means you just exposed yourself to additional loss. It's never a great thing when that happens, but that really does happen with market orders very often. And so let's look at this a little different. Let's say you did buy it over here and you wanted to sell if the price got down to 230, but you don't want to look at your phone. You don't want to have to do that. You want to set it up to be automatic. That's called a stop loss. So with stop losses, there's two different ways people kind of talk about them: a hard stop or a mental stop. A A hard stop means you are going to put it in the computer and your computer will sell that order, or your broker will sell that order at, in this case, $230 or less. Could be anything less if you use a market stop. So, you picked up your shares, hypothetically. I'm just going to draw this line in up here. We'll say you picked them up at $232, okay? And you want to set up a stop loss at $230 down here. We'll just change these colors to make it easy. So you want to sell if the price gets to this. So you'll go to sell 100 TLRY, stop on market, and you type in 230. So that means while you're eating lunch, you don't have to be looking at your phone, and then the price kind of moved up here, and then it drifted down while you were eating, and it got down to 232. Well, with the stop market, if it hits 230, it's going to sell it. Now, if it hit 230 because this stock price went from 232.85 down to 227.58 in the blink of an eye, because your order was at 230 and it's a market, that means that it's going to sell at 230 or less, and you can't control the less side of that. So your order could sell at 227, 220, it could sell at 227.90-ish, it could sell at 228. You don't control that with a stop market. Now, the great thing about a hard stop like that is that the stop is taken out of your hands. So it takes kind of the psychological aspect out of your trade, which is good in a way, but it can be dangerous in another way because it exposes you to additional risk. Now, you could do a stop limit, and you could say that, you bought at 232. You want to sell if the price gets down to 230. That's the activation of the stop. But you don't want to sell unless it's at 230.05. So that gives you a couple different ways that you can control this. You can say, I want to sell if it hits 230, but it's got to be at 230.05 or better. So that makes it to where you limit your risk a little more, which is even better. Now, let's say you're further along in the day, after lunch, you're back at work working or something, and you see the stock has gone up quite a bit. You'd bought earlier at 230, now it's at, look over here toward the right, it's 244.50. You want to sell, but you want to sell it at 260 or better. No less, only 260 or higher. So you'll go to sell 100 TLRY limit, and you're going to put in 260. That means that you can continue working, going about your day, doing whatever, or if you're a day trader and staring at your computer, you will sell at $260 or higher. So that makes it to where you have opportunity to sell, but if the price moves really fast and let's say goes 261 in the blink of an eye, and you want to sell at 260, your order could potentially get filled in there in that blink of the eye. But let's say you saw the stock had moved up, and let's say you were unfortunate and you had bought at 230 and you saw that the stock kind of crashed down to here, back around where you bought it. You were like, oh, it was up to 300, now it's down to here, I want to sell. So, like I said, you bought it 230-ish, we'll say, and you see that it was up to 300, go back to work, look at your phone, and you see it's all the way back down to where you bought it. And you want to hurry up and sell. So you put in a sell, 100 of TLRY at market. If you hit that button and it's at market, it could fill you at 226.59, way down here. It's not real fun, but it can happen. That's what happens with a market order, because you're going to get filled at whatever anybody's willing to buy it at. Now, if you had done the same thing that we talked about earlier and set the stop at 230, and you had bought at 232, well, in the blink of an eye, it dropped to 226.59, and that's where you could have got filled on that order. And you're probably thinking to yourself, well, I set my order up to where it would, sorry about that, on the chart there. I set my order up to where it would sell if I hit 230.02. Well, what happens with those stop markets is it's going to fill you any price below that. And let's say it filled you way below here. Here's the price, and let's say you put in that order on this candle, and then immediately it drops down to here super fast, like this is a whole minute here, so, it probably wouldn't be this bad. but you put in your stop market at 230, and then 1 second later it's at 198.62. It could fill your order there, and you just lost additional capital. You know, some people a lot of times will say, I'm going to put in a stop. You don't know if it's a hard stop or a mental stop. Mental stop just means that in their mind they'll sell if it gets that price. Do they always? We don't know, because they're just maybe on the internet saying they're setting a stop there. But, so, I don't know if that helped at all. You know, I wanted to explain market, limit, stops, and all that stuff, because I get questions from friends about it, and I want to try to explain it. But if you guys are confused at all, you let me know, and I'll try to explain it any way I can, maybe a little better.